powered by Reviting, streaming from the Reviting Digital Studio. It's the David Daily. Exploring frontier technology, artificial intelligence, quantum innovation, and the intersection of faith, funding, and the future. Here's your host, David Goki.
Hello and welcome to another episode of the David Daily Show. Today we have a special segment, Funding, Faith, and Future Tech. I'm so incredibly excited to have our speaker today. I'm going to welcome him to the stage and give him an opportunity to introduce himself. Anthony, welcome to the show today from our hometown, New York.
Yeah, thanks for having me.
Yes, it's awesome. So tell us just a little bit about yourself and how to correctly pronunciate your last name and what you love doing today in the city.
Definitely. Yeah, name's Anthony Georgiades. I run Innovating Capital. We're a technology-focused asset manager based in New York. We're really focused on deep infrastructure-oriented investments across a number of sectors, ranging from cybersecurity, enterprise infrastructure, Web3 infrastructure, opportunistic areas like quantum computing, and we're really focused on really building platforms across these areas, whether it's early stage venture investments, more mature growth oriented opportunities, rolling our sleeves up and getting involved with founders and collaborating across their journey to exit.
Yeah, I love that. So the way we structure this show is we have three awesome topics and three key areas that really dive into your background and expertise. And I'm really excited today because not only do you have actually product experience and a graduate of Wharton, but you also have lots of board experience as well. So you could speak from a board member and fiduciary as well as a fund manager as well yourself. So we're going to jump right in. The very first topic that we're talking about today is that early stage infrastructure risk and portfolio strategy, specifically around AI infrastructure. So what do you define early stage? How do you really define early stage, and what is a key aspect of that technology infrastructure? I'm excited to get into the weeds with you.
Yeah, basically, if you think about the early stage life cycle of investments, really it largely depends on what the underlying product is. Early stage in software might be very different than early stage in hardware, might be very different than early stage in biotech or quantum or life sciences, right? But really the thing that kind of permeates across all of those is, when you're an early stage business, a lot of times you're at a point where you don't necessarily have a proven product market fit. You don't have a fleshed out idea for how we're going to necessarily generate scalable revenue or potentially even turn profitable. And it's really an exciting time for a lot of companies because you're really innovating and developing on what could be a very disruptive idea, leveraging new different types of technologies or efficiencies, and how that can actually really change and disrupt entire verticals and segments. And it's very much so exploratory at that point in time.
Yeah, I like that, especially early stage. Today we have so much technology, and having been ex-Microsoft myself for 10 years, it's like the technology is always changing every 6 months, and you need to stay really relevant for those new technology pieces. So in today's day and age, how can an early stage startup invest in their technology today to prepare them to be maybe future proof when it comes to risk assessment?
Yeah, so technology is obviously everything, right? When you think about the landscape of what companies are building, especially with what's happening with regards to AI, I think the biggest thing is, it's not necessarily just adopting AI or using AI. It's kind of redesigning around it. A lot of what we're seeing as winners and champions in the space are really redesigning a lot of their workflows, from first principles. So ask yourself, if you're an existing startup or if you're starting to build a new company, right? Or even if you're a mature business, if I was starting this company today, what would we automate from day one? What roles wouldn't we potentially hire immediately? And what processes would be really software first, human second? And at that point, it's really AI isn't just a feature layer; it's part of like actual core operating itself, and that permeates across a number of different functions, ranging from sales and marketing to product development and enrichment to developing business plans. And actually, we at Infinity Capital are using AI as well a lot for a lot of our own analysis and processes in place. I'd say the other thing too is with startups, especially with the way the world is going, it's much easier and quicker to go out and develop a company from day one and to innovate from day one. And you can start to use AI to really compress a lot of these fixed costs very early on. Most early stage companies, die from burn, not necessarily competition, right? And so if you can use AI to potentially augment or enhance, certain roles, automate certain outsourced functions like customer support, even speed up product documentation, huge weakness for a lot of companies. They build something, they deploy it, they have a bunch of amazing tools and APIs and SDKs for their users, but they fail on like that last mile delivery point where, hey, we need to actually build documentation that allows our users to actually leverage this stuff, demos, etc. So the goal isn't necessarily being super novel. It's about how can we extend runway, and how can we better enhance obviously the customer experience in doing that.
Yeah, I like that. And you're starting to touch a little bit on AI and funding. But what I want to do is really focus in on your experience as a GP, a general partner, right, of Innovating Capital. You've had the business now for 9 years plus, right? So you went through 2018, you went through 2020 in the pandemic, and then, of course, the influx of capital we saw in the early 2020s. And so, kind of putting that hat on as a fiduciary to the portfolio, how are you managing portfolio risk as a GP?
Mm-hmm. Mm-hmm. Yeah, so obviously portfolio risk is a huge part of the job, right? Um, when you're allocating really to emerging, you know, managers overall, in general, and when we're emerging managers in the sense of founders in this regard, both it's first and foremost the idiosyncratic risk and it's the systematic risk, right? From an idiosyncratic perspective, it starts with technology and understanding the technological risks and points of entry that really permeate what we're investing in and backing, right? And so when we're looking at companies that are, let's say, in the world of enterprise infrastructure or whatever it might be, what is that actual point of inflection? What's the have to have? And is this easily disruptible? Is this easily replaceable? What's the incremental dollar that this is going to capture and offset on the counterparty customer's books? And is this going to be a viable, sticky point of entry moving forward? Obviously, from a portfolio perspective, there's a lot of systematic components that tie into that. Both by making sure we're not overexposed to both specific sectors, but then specific sub verticals within those sectors of themselves. Likewise, you have to look at it even broader. Do we have certain portfolio companies that each of them might have their own diversified base of customers, but in aggregate, do we have one portfolio company here and one portfolio company there that generate a majority of their revenue from ultimately the same customer or the same end market? And now we're exposed to that kind of, second derivative layer of potential risk that we have to analyze and understand overall. And so there's a lot of factors that go into it. It's not kind of a one size fits all approach. And you have to really price each security and each investment accordingly and how it fits within the broader portfolio and how it adds both incremental alpha, but potentially beta as well to the portfolio.
Yeah, I love that. And this is such an interesting topic. When we built our risk model at Microsoft, there were so many factors that went into that, call it like a risk score. So I'd love to maybe dive in just a little bit deeper on a particular example of either a company itself, an industry, or a vertical where you and your partners set up a strategy to de-risk. Maybe take us through like, how did you identify that there was potentially a threat that had a financial outcome or non-outcome, and then did you say identifying the risk and then the action maybe that you took to address that concern, and then a tangible outcome and how that affected both the individual company or portfolio company and your broader business?
Mm, hmm
Is something that comes
Yeah,
to your mind?
yeah. So I'm trying to think through. I mean, yeah. So I guess the probably most recent example, I won't necessarily, kind of, share the name, but we invested in really a high growth SaaS oriented business, AI
Mhm.
enabled, etc. And on paper, you're seeing, tremendous, strong ARR growth. You're seeing very splashy enterprise logos. You're seeing significant AI native positioning. Raised. We were a seed investor in this company. They raised a very significant Series A and then a very significant follow-on Series B with significant institutions. But internally, we really kind of saw three key risks. The first was really tied to revenue and quality of revenue, right? Same way that companies are measured on quality of earnings, quality of revenue, and quality of ARR is just as critical, if not more critical, for certain companies. There was what we viewed as, both too much pilot revenue, too much short-term durated contracts, and really weak and not necessarily expanding net revenue retention overall. And this got us concerned with really the second risk pattern in terms of just overall, burn misalignment with the company. They were continuing to hire across, different sales functions, growing at all costs, right? Growth before anything else. Before really narrowing down and hammering the pricing model of what they were actually selling. And effectively, before we thought that they had achieved product maturity, more or less expanding the sales team before the product had fully stabilized. Just building backlog, trying to build ARR, but not quality ARR, if that makes sense. And the narrative, really, in terms of when they got their Series B too, is the valuation was more or less priced for perfection. Market kind of assuming this inevitable category dominance. And so this is where, when we looked at this, on paper, you see numbers that look strong, checking all the boxes, big round, right? Strong investors, but looking at it from more of the lens of, let's say, a kind of, operator forward or even kind of private equity-esque investment, we took more control, in terms of our ability and governance rights and being on the board, and more or less pushed the company, instead of leaning into this kind of growth at all cost and basically grabbing as many logos as possible, shifting from a lot of these pilot customers to really two things. Both multi-year deals at a significant discount to potential, entry bookings, as well as offering a lot of clients a more freemium-based entry point. So this was a unique thing that we were kind of pushed back on, or people had pushed hard on, for the following reason. The company had a very strong entry point into really a very isolated proprietary mode of data. Couldn't monetize on that data immediately overnight, but while the business was focused on gaining logos and pushing revenue forward, that led to obviously inevitable churn. And that churn also led to a churn out in data streams that we viewed as being potentially more valuable over time. And so we had basically told the business, put a full freeze on sales hiring, reallocate some of the budget towards product stabilization, reallocate some of the budget towards repricing and remodeling the different points of customer contracts and things like that. And let's obviously assess certain scenarios, modeling for some of these slower growth assumptions. And then how can we also build out a new product stream to monetize on that data overall? So the outcome, I would say in general from that is, when the market corrected, really honestly in the last year or so, a lot of competitors that were aggressively burning either did these down rounds, disguised as these inside-led bridges or these extension rounds. But we had now established a business that, while it had seen a deceleration in growth, it had seen an expansion in net revenue retention. It had seen an extension of runway by a couple of years. And it started to actually convert some of these pilot accounts into these multi-year enterprise agreements, and had tripled its data layer, right? Its overall kind of special sauce in terms of the amount of data it captured. And so now we're actually out in the market and looking to raise in what we view as a generally tough market, but we're seeing significant interest and a lot of actually potential acquisition, interest as well in this business based off of this overall data aggregation piece that we've pushed the company to adopt as well, if that makes sense.
Yeah, wow, there was a lot there, and I'm grateful for that level of detail there. I want to break it down a little bit, but in short, I'm basically hearing you say the first thing was we needed to have quality revenue, right? The second thing was quality burn, and the third was essentially industry value and realignment in that industry valuation. Especially when we saw the significant number of down rounds. I saw a report 2 years ago that was really interesting. On that period for 3 years, you saw majority of businesses doing down rounds except for like emerging AI and quantum. So if there's a business here today that is going through a down round, or say, for example, you're sitting on a board of directors and you need to reallocate funding from people, COGS, and revenue to, I think I heard you say, reallocate to higher quality products so that you could have better net revenue. And then also you went into more of these longer term pilot agreements that you essentially are now able to capitalize on, reevaluate the valuation of the business so that you can raise more capital in the next round. So as a GP or a board member, what does that conversation really look like when you're sitting here, guys? Like, look, we love the sales numbers, like go, 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 but we've got to retain some of this quality revenue. And we really need to start shifting our quality to product so we don't lose customers on the other side when they have a terrible product experience, or there's other things that are kind of broken and not able to sustain that. How do you really, as a board member, lean into that and lead that type of a discussion and start to really steer that ship so that, there's so many companies that had down rounds. They're thinking the same thing. How do we turn this around, get a better round in the future so we can serve our customers and shareholders better?
Yeah, it's not always easy to have those conversations, right? Typically when we enter into these investments, we're very level set on expectations, very aligned on obviously our involvement, what we bring to the table, what we do, what we don't do. And it's one of those things where we've really built, deep relationships with these, management teams where, they, at least I hope in a lot of respects, they view us as a fully aligned partner. And so more times than not, you'd be surprised how collaborative it is, right? Now you do get certain situations where it's potentially obviously more resilient or resistant, and again, it's their company, they're operating it, it's their idea, and in those situations, there's no one size fits all approach. But what I found typically works the best is really just laying it out there in the sense of, hey, while this is happening, if XYZ doesn't happen, this is where we're going to be in 18 months. And when most of the times our kind of base case modeling is more is far obviously more bearish than what the company's base case modeling might be. You look at our upside case scenario, and that tends to be close to the company's downside case scenario. And so really explaining it to them in a way where they both see and understand the exact implications of what can happen, but simultaneously having a productive outcome and approach to it, not just saying we're going to cut, sales for the sake of cutting sales, but we're going to reinvest in a new product rollout, new areas of innovation, new areas to serve the customer, right? So we're continuing to move forward and we're continuing to go up the staircase. We just might be taking a different path to the end goal, right? And that's the most important part is having a much more collaborative approach versus just saying, hey, you need to do X, Y, Z, figure out how to do it, figure out how to cut these costs, figure out how to do this. But being really involved in the overall vision and the strategy is what builds a lot of that kind of trust and goodwill.
Yeah, I like that. And to build on that too, in terms of building stronger infrastructure, de-risking, there was an interesting article I saw that you were published in Investment News late last year, talking about building stronger infrastructure and real-world utility, especially when it comes to fundraising and venture fundraising shifting. I'd love to maybe lean into our second topic here. So our second topic today with Anthony, who is a founder and GP based here in New York City. It's really wonderful to have you on the show. Without speculation, I'm not a financial advisor or anything like that, but just for people who are watching this either now or later, in the past month, we've seen a 30% sell-off on crypto. So crypto is very cheap today. Gold tanked a couple weeks back in a single day, kind of a sell-off, but that's kind of back. So in seasons of volatility, kind of future-proofing this question, how can a business build a stronger infrastructure in their business as it relates to currency, digital currencies, and alternative forms of fundraising? And how is that? How does that apply, or how does that relate to your personal view on how venture funding itself has shifted today and will continue to shift in the future?
Yeah, and I guess just for context, when you say infrastructure in this, discussion, what are you implying, I guess?
Yeah, I think we want to kind of lean more towards the funding aspect of that. So funding infrastructure and funding maybe macroeconomics that will contribute to the stabilization. So for example, if you had an investment in crypto previously, before markets changed, then maybe your run rate would be lower today. However, if you take an investment in crypto today when prices are low, your run rate may potentially increase tomorrow. So from a funding point of view, I think is the main focus on creating that more secure stabilization when I'm talking about infrastructure, because funding, right, is going to lead into reinvestments in people or technology. So really focusing on that funding aspect.
Yeah, and I guess, so, okay, there's a few things here, obviously. I think one of the biggest mistakes that a lot of companies make, especially in the world of digital assets, is mixing treasury exposure with operating liquidity. It had crypto exposure that went down.
Right.
Big question, was it the right trade? Which isn't necessarily the question you should be asking. It's, did that volatility, did that feature of Bitcoin being highly volatile, did that feature of Ethereum being a, asset at work in terms of its staking yields and whatnot, did it work if it impaired payroll, or if it impacted vendor relationships, or if it shortened our runway, right? And so if you're going to employ a more exotic or sophisticated overall treasury strategy, you need to have a very tight-knit control where operating capital is insulated from some speculative exposure, and treasury strategy needs to have defined risk buckets. I sit on the board of a publicly traded digital asset treasury. We have obviously three different pillars in terms of how the business operates: the core operating business, the tokenization or data component of the business, and the digital asset treasury. On paper, it's one business. Internally, it's three isolated categories where we look at liquidity and solvency across each of those buckets on an independent basis. Now, of course, certain of those can be invested into the other and fuel growth for the other. But what's critical is understanding that hey, these are very well defined and well managed risk buckets overall. Not never necessarily letting volatility dictate if I can run payroll next week or things like that. Macro shocks, as you alluded to, expose that dependency. We saw it obviously with FTX, right?
Right.
Where obviously large amounts of information coming out on that in the coming weeks in terms of what really transpired or not. But at the end of the day, there was a misalignment or a mismatch of certain assets, and a macro shock obviously exposed certain of the dependency to illiquid assets, and led to a liquidity mismatch overall.
I would say that would accurately categorize what happened with FTX, a liquidity mismatch.
Definitely.
Yeah. If everyone's going to the bank and wanting their hard-earned crypto converted to fiat currency, and there's no money in the safety deposit boxes, yeah, that's going to be a problem, right? And you see that happen not just with FTX, but you see that happen, and I think that will continue to happen at a macro level, because you see this happen at a large scale. So are there macro, maybe call it not necessarily regulation, but from a de-risking point of view, how does one de-risk themselves from things like an Enron or an FTX or the next rug pull when it comes to funding?
Yeah, so obviously the biggest thing is, first and foremost, there are a few things. One, you need to build funding redundancy really before you need it. Smart companies have multiple banking relationships. They establish lines of credit, access to revolvers, access to the credit capital markets before distress, before they need it. They've been consistently cultivating strong equity relationships, and then they have a lot of potential strategic optionality, mezzanine financing, things like that. In crypto, it's similar, right? You have multiple custody partners, you have multiple execution partners, you have counterparty diversification. And that redundancy is kind of like the survival insurance. And then simultaneously to that, right, from a macro perspective, macro isn't necessarily background noise. Businesses, any CEO or CFO, from my perspective, should, or at least have investors that do this for them, that track things like potential liquidity cycles, private and public credit spreads, rate expectations, potential regulatory shifts, institutional flows, because that macro really drives capital cost. And that capital, if you're a startup, right, and you think about where that capital comes from, well, that capital comes from venture funds or managers. Where do they get their money from? They get their money from their LPs, and their LPs ultimately are getting their monies from obviously swaths of capital that are predicated either from bank originations or government funding, whatever it might be, right? Pension plans, et cetera, et cetera. And so it's really kind of a trickle down component in a lot of ways, where the macro drives the cost of capital and how it finds its way into any end market, especially in the private markets. And the capital cost ultimately determines survivability, especially in illiquid assets, which come to have a significant kind of discount or premium, either way you look at it, given the illiquidity component.
Wow. I feel really lucky to be having you on this show with such deep expertise. I mean, there's so many questions I have. For example, like, how do government bonds and debt financing intersect with large AI companies as we see that shift happening? But that's going to be in topic 3 when we talk about AI and digital assets. I really want to lean in more to how venture funding has shifted. Maybe we can focus on Series A companies primarily. So for boards and fund managers who are getting ready for Series A, or they're exiting a Series A going into Series B, what does that venture funding landscape look like from your purview today? And how can companies best take advantage of scarcity of funds, higher expectations, onset of future tech. What does that really look like for people who are listening to this today and, in the near future?
Yeah, so I guess just to take a quick step back, I think what's important to understand is like what's going on right now in the world. In the late teens, early 2020, 2020 through 2022, there was a lot of easy access to capital. Again, you had a very accommodating, macro policy in place and monetary policy in place. And so, that kind of downstream effect, you had a lot of ultimately LPs and venture funds, chasing both access and, potentially, massive growth and potential liquidity opportunities. But the core metric of, DPI or realized gains was weirdly secondary, right? And it was because that speed of deployment mattered a lot more than some of potentially the underwriting, discipline. And so
Right.
managers and consequently portfolio companies and startups were a lot of times,
Right.
for exposure to a particular thematic trend, potentially crypto, climate change, right? Energy, right? Rather than potentially execution quality. And, you saw that
Right.
all across the board, SPACs, et cetera.
Yeah.
Now, going back upstream, LPs and subsequently venture funds and capital allocators are heavily liquidity constrained. And what's important is obviously both returning and recycling capital. If you look across the board, I mean, we've seen it, the allocation to, venture from, let's say, institutions or pensions or, LPs, limited partners allocating to GPs, while their overall books have, maybe grown on a compounded basis of, 6 to 8% per year, their allocation to venture as a percent of that pie has gone down, right? And it's gone down, significantly. And so LPs who are re-upping in certain GPs are really hyper focused on, realized gains, real portfolio company traction, thoughtful pacing, certain risk controls in place, because you've seen so many markdowns, you've seen so many permanent situations of impairment, and you've seen obviously certain areas of very egregious fund level leverage that has impaired obviously equity value as well. And so this behavioral shift in the manager, where, you might be, less necessarily, leading a smaller fund size, doing more fundless sponsor SPV type deals, maybe having more concentration in high conviction names or longer hold periods, or really kind of more of these kind of co-invest structures and whatnot, has obviously ultimately impacted Series A to Series B opportunities, right? If you're not necessarily in a situation where you have an existing sponsor relationship that's going to significantly re-up in the new deal and potentially anchor that Series B funding, what you're seeing across the board is, just that, right? A lot of kind of down rounds or bridge rounds, safe or convertible note offerings that have these liquidation preferences and more or less prime the existing equity, more akin to what venture used to look like back in the days of Charles River Ventures and whatnot. But basically, with all that in mind, if you're building a company and getting ready to go to market, this doesn't necessarily need to sound like, doomsday by any means. It just means that execution matters more than ever, and that you need to have a very, very clear, defined path to product excellence and execution, where it's not growth at all costs, but it's, hey, this is why this business is sustainable overall, and this is what we're going to do over the next 12 to 18 months. If you're going to give me capital to hit these milestones, here's how I can do it, and here's how I can do it for half the cost. This is how I'm thinking outside the box. This is how it gets you a better return on equity or return on asset. And so it's really important to have that kind of thoughtful pacing, but that, double down assurance on operational excellence and execution.
Yeah, I absolutely love that. For many reasons. First of all, it's the humans that are creating that efficiency, right? It's not robots, it's not AI, it's not going to be any replacement of that. First of all, I wouldn't have this show if you were a robot. So I'm glad that we're able to connect. And I love the city sounds in the background there as well, just giving us a real New York feel. So as we like lean in a little bit to that, I'm hearing capital efficiency is so incredibly important. You gave an example earlier of how you took a company who was flush with capital and actually driving lots of revenue, but not product and capital efficient. So in this new landscape of venture funding, where businesses are looking for and LPs, GPs are looking for more efficient capital, how does a board of directors drive that capital efficiency in this new landscape and really drive um, not just the intent, but real measurable capital efficiency results with less capital, so that they can meet and reach their milestones with less capital? How can they do more with the same?
Yeah. So you want the AI answer or the non-AI answer?
I want the no bullshit, Anthony. Like, I'm saying this back in this year, and we could look back 5 years and be like, oh yeah, he was speaking off the cuff. Like, give me the New Yorker City answer.
Yeah, so obviously the new landscape overall is, capital is far more selective. It's slower, it's more milestone driven, and it's really less, forgiving, right?
Right.
Especially with, everything we just talked about in terms of the financing environment, rounds taking longer, valuations being scrutinized, more down rounds, followed capital not guaranteed. So the one thing that really boards should do is kind of force milestone clarity in a way, right? Because they're going to probably get this from investors too. There's investors out there that have moved to a very kind of pure milestone based, financing. You're seeing like high growth Series A to Series B companies that are getting, term sheets for, hey, we'll give you a $30 million Series, B, but it's 5 million, and then it's 5 million if you hit this, 5 million if you hit this, 5 million if you hit this. By the way, if we put that cash in, the valuation resets based off of the compression or growth of ARR based off of the budget. So, you better hit it, otherwise we're going to own the business, et cetera, et cetera. So when capital is being allocated that way, boards should also be thinking that way too. What are the exact milestones that really kind of unlock that next round? What metrics actually matter? What actually proves product market fit, and what really de-risks the business model? Problem with a lot of boards and board meetings is you're looking in arrears, right? You're looking in, it's middle of January or early February.
Right.
You're talking about Q4 results. What is that going to do, right? You don't just sit and check boxes and have a board discussion that's, looking at results and where we're going. It's really, okay, where are we literally today? Where are we going to be tomorrow? What exactly are we doing to get there? Not vague goals like grow ARR by X percent or grow NRR by, Y percent. But how do we actually define and unlock that specific milestone? Otherwise, you're just spending money and kind of, throwing it blindly. Simultaneously is, really the shift from kind of more growth oriented targets to efficiency targets. So simple, right? Metrics that matter, now more than ever, that, we've always spent a lot of time looking at, that the, traditional private equity, no growth type businesses always look at, that seem to matter, like that pure unit economics basis, revenue quality, sales efficiency, burn multiples, CAC payback, things like that. Capital that has efficient growth is really what gets funded, because there's a clear payback to the return on equity there and the return on assets. And I know if I spend $1 on CAC, I'm going to generate 20%, 20% return versus, potentially throwing it blindly. The other thing too, just a couple other things is, obviously from kind of projecting runway, above all, where you are more aggressive in modeling the downside scenarios. And hey, those downside scenarios are actually more likely than you think. It's not a bear case doomsday scenario that could happen, 5% of the time, but it's, a potential flip of the coin scenario. And so in that case, where are we actually going to be? And that runway, really equals that same negotiation leverage too. right? If you're up against the clock to get cash in, what do you think happens in a negotiation room versus if you have cash in the bank for the next 2 years and you got time to figure it out? And so those are some of the things. Obviously, I was alluding to the beginning in terms of AI, and we could spend, hours talking about that. But I think companies need to be fully embracing of certain tools and resources that can support, obviously, runway in the form of obviously automating certain tasks and deliverables, and being more open-minded that they themselves can quickly become displaced.
Yeah, I like that. There's so much there. Yeah, we could definitely dive into. I think each of those topics could be like a special segment or episode where we dive even deeper into that. What I like is this aspect of milestone-driven capital efficiency, right? If you have a milestone-driven capital efficiency mindset as a board of directors, then each board of director is also being held to a milestone completion, right? As well as each individual human and entity that is supporting that growth target. So, to your point about leading indicators, not just lagging indicators, when you have a leading KPI, you can look at the capital efficiency, say, for example, of the investment in your CAC return, right? And the lifetime value of that return based on, say, product quality metrics, as you mentioned earlier. So yeah, you need product quality, and you also need to be more capital efficient. And sometimes being more capital efficient means bringing in some AI automation or some technology that can potentially replace underperforming assets, even if it's human capital assets, right? So these are the tough conversations that we have to have about people and the role of technology, and the role of technology really replacing some of those mundane tasks, especially now with agentic AI and Claude bots and all these things that are coming out. Of course, tomorrow there'll be new technology that will drive more efficiency. So as we go into this third topic, I'm so excited about this. This is one of my favorites: AI and digital assets in long-term allocation. And my very first question that I want to lean into, which is so time relevant, is we see these massive country government entities really taking some of their maybe government-backed bonds and financing and treasury notes to finance these massive infrastructure investments, very much like they would a utility like power, gas, electric, sustainable like wind and solar. So as a traveler myself, I'm seeing some of this play out in secondary and third world countries as well. But I'm really curious to hear your perspective, Anthony. I think you're going to have a unique perspective being in the Big Apple with me. What does that look like? How do companies and organizations think about this kind of massive governmental shift in tapping into big AI architecture and infrastructure?
Yeah, so I guess, are you kind of getting at, how obviously the government capital allocation in the world of AI infrastructure is, impacting just, macro or specific companies, or all the above?
Yeah, I would say start with the macro, and more so because AI is here today, but tomorrow it will be post quantum cryptography, right? So in the world of future tech, you're seeing governments debt financing tech infrastructure in a unique way that I don't think we've seen historically in the history of our world. Yeah, maybe you would have had infrastructure investments into innovative technologies like roads, railroads, aqueducts, electricity infrastructure, that sort of a thing, Wi-Fi infrastructure, 5G, et cetera. But those are primarily driven from a corporate level. What we're seeing is like government bonds and debt financing intersecting with big tech investments, and not just internally in one country. You're seeing cross-country and global investments in that. For example, what NVIDIA is doing with China, what the US is doing with Saudi Arabia, and other countries that come to the table want to play. So the real question to start with is that more of the macro observations that you're seeing on how this is moving forward and addressing the, call it the private equity and venture funding markets today.
Yeah, so I mean, there's obviously a lot to unpack there. I think the first thing I'd say is, the government has obviously been doing this forever, right? Strategic capital allocation at the sovereign level, whether it's into defense, digital rails, semiconductors, wind, solar, etc. It's not charity. It's industrial policy, and it happens in a bunch of different ways. It can be government issued bonds. It can be sovereign wealth fund allocations. It can be SBA, denominated SBIC funding. It can be subsidized credit facilities, right? There's a ton of SBIC funds out there managed by large institutions and credit managers that just raise funds all in the form of, government funding from a local bank. And that government funding obviously finds its way across, private equity companies, venture capital funds, startups, etc. You also have a lot of public-private partnerships and whatnot. And so, why I think the important question to ask is, why the government does this in general. And governments typically fund, what kind of determines, national power overall. Same reason why we funded a lot of oil in the 70s, or manufacturing in the 80s and 90s, or chips in the early 2000s and silicon and whatnot. And right now you're seeing whether it's AI in the form of needing obviously the different parts, water, electricity, semis, obviously energy in the form of potential uranium enrichment or things like that for a variety of reasons. These are assets, right? These are geopolitical assets right now. And so when you look at it, there's kind of a long duration investment problem overall. Most private markets, what could potentially get allocated to these kind of innovative, infrastructure type opportunities, you have private markets that, want and need liquidity. They need to avoid this sort of 10 to 20 year payback curve. There's very few funds out there that can raise capital and deploy into these infrastructure initiatives that have 20-year periods. There are managers out there that do it and they're really good at it, but there's very sector specific ones. And because infrastructure has this slow monetization, this massive upfront capex, national spillovers, regulatory headwinds, and slow monetization, the government capital really understands that and absorbs a lot of that duration risk and mismatch. So when the government comes out and issues these bonds to fund innovation, what they're effectively doing is, not only are they expanding a fiscal balance sheet, but they're being very targeted and strategic in directing capital into targeted sectors. They're also influencing capital formation policies. It's part of the macro policy overall. Take AI as an example, right? Government issues bonds, capital flows into a development bank. That development bank then turns around and funds a data center, a research lab, early stage grants, guarantees certain loans, right? Then private capital comes and layers on top of that infrastructure. Government capital usually is almost, weirdly enough, a leader in some of these sectors because it provides the funding and capital needed for a lot of that early stage uncertainty de-riskment. And then that crowds in a lot of the private capital overall. The macro implication, I'd say, is where a lot of this kind of gets, fascinating or interesting in some respect, right? When you look at like a area like, let's say just infrastructure overall, right? Not only does it reduce private risk, but it dramatically lowers the cost of capital and it accelerates some of the sector consolidation. So what that means is you really start to shift capital from kind of consumption to investment. And, frankly speaking, when this innovation is more or less, bond financed, the monetary angle here is obviously, we've seen it today, debt increases, but liquidity starts to enter into targeted sectors. But that leads to obviously asset price inflation in those sectors. Talent potentially reallocates into those sectors, private capital follows, and it becomes more of a sectoral monetary stimulus. So industrial policy, in short, is monetary policy with a target, if that makes sense.
Yeah, that does make sense. There's a lot there, and you're exactly right how to unpack all of that. So maybe diving down into the micro, making this really practical for an LP or maybe a founder that's in that space of raising funds. how do you de-risk your infrastructure and align that to the macro trends that we're seeing? Like finance is getting pretty creative, right? So for example, where do you feel like what is that infrastructure narrative that uh, mid, you know, mid-stage startup needs to really have to appeal to LPs and GPs like yourself and your colleagues?
Yeah, so away from infrastructure, kind of in the lens of that.
Yeah, in the lens of infrastructure to de-risk, because our first topic, right, was about early stage infrastructure. So as we see these macro trends with government and public sector, as well as private sector, and then actually the debt financing increasing liquidity as well, which is kind of an interesting trend we're seeing currently, right? What narrative does a startup that's scaling from Series A to Series B on an infrastructure side? What does that narrative need to really contain? What are some of the elements that would need to contain for an LP? What is an LP looking for in that infrastructure de-risking narrative?
Yeah, so I mean, I guess to go back a second, right? Like the main thing is basically, if you think about everything I was just saying, right? You know, there are some LPs that aren't necessarily just underwriting startups. They're underwriting, positioning within, let's say, macro industrial policy overall, right?
Exactly.
And so, what LPs might ask is this startup building in a tailwind-oriented sector backed by said sovereign alignment,
Right.
or
Interesting.
or swimming against kind of a macro current? And that's kind of the filter. And that's why you've seen like what's been kind of, I'd say, the not weird, but the interesting anomaly in terms of sectors that put AI aside, but besides everything that's happened there, the sector
Right.
that kind of not been so heavily scrutinized and re-rated is a lot of energy tech right now, whether it's things
Right.
like laser isotopes or uranium enrichment or whatever it might be. And you have companies that are not generating revenue but trading at billions and billions of dollars because they have a consistent source of potential government contract and stability behind it to really reach those objectives. There's a lot of capital markets things you can do with those types of businesses too to continue to generate liquidity. But if government bonds are out there and they're funding energy grid, digital infra, defense adjacent tech, LPs are looking for, how do I get exposure to startups that sit on top of those rails? Does this company benefit from those policy tailwinds? Is it upstream of sovereign capital? Is it complementary to regulated infrastructure? Or is it part of the supply chain kind of resilience overall? And so startups that are somewhat aligned with industrial policy have lower capital risk. And so if you're building a startup, right, and you're building, let's say, a application layer height versus potential foundational infrastructure, right? Let's say you're building storage, or you're building secure compute, or you're building settlement rails. That's durable because it's sitting on that foundational infrastructure level. But if you're building, let's say, front end based, clones or wrappers or narrative first products, that's a little bit more fragile. And the difference in the scrutiny across those two is becoming kind of more hyper focused on, given obviously some of these geopolitical and macro trends we talked about.
I like that. So that's awesome. We're running out of time here, and we have a special anchor segment coming up. But before that, I want to do a really rapid fire set of questions because lots of these are very long-winded, which is really fantastic. But I want to get into that future piece. So I'm going to ask very quick questions. Maybe we'll do rapid fire, maybe 3 to 5 words, maybe one sentence. So where is the biggest infrastructure misallocation today, in your opinion?
Where is the biggest infrastructure misallocation today?
Yeah. Mm-hmm. Rapid fire. What first thing on top of your mind?
Clean energy.
Got it. Next 10-year AI layer, 2035, 36. What's that AI layer that's going to be present in 10 years?
MCP and agentic automation at a scale that we don't even interact with it.
Exactly. What breaks first in AI?
Existing solid state LLMs.
Yep. What's an overfunded segment today?
Existing solid state LLMs.
Nice. Double whammy. New fund model emerging.
A lot of liquid funds out there. I don't fully buy into the model, but it makes sense in some respect.
All right. And finally, one belief that few share.
Sorry, what was that?
One belief that few share.
Web3 is not dead.
Yes. All right. This is so great. I love it. All right. So we're going to go into our final anchor segment. Anthony, it has been an absolute pleasure. I feel truly honored and blessed to have you here on the show. We don't get an opportunity to have people with your level of experience, candor, stability, direct answers, very high level, but also very deep and detailed. So right now we're going to go into our anchor segment, which is called Beyond the Bag. It's so simple. What is one thing that is in your bag that you cannot travel without? It's a surprise for me. It's a surprise for our audience.
One thing that's in my bag?
Yeah, in your laptop bag, your backpack, your satchel, your briefcase.
Definitely my laptop.
What's that?
Definitely my laptop.
Do you have it? Okay, you have it with you. Okay, in addition to your laptop, is there something as well that you carry with you? For example, I'll share. I have a La Campagna bag, Paris to New York, and in here I carry an LED flashlight because sometimes when you're, traveling and you don't have a light, it's nice to have a little light here. Is there something like that that's in your bag, or maybe by your desk right there you could just grab? It's like right there, right in front of you. You can't go wrong with an answer, but I'm curious, what is like within arm's reach?
I love this Pure Body. I carry it around. It's a gut and body detox. It's fantastic.
What do you like most about it, and why is that something you carry with you?
Just anywhere I am on the road, no matter what I'm doing, it's just a natural liquid zeolite. It just really helps in terms of obviously just kind of consistent cellular reproduction and just constant obviously detoxification.
Awesome. That was the answer we're looking for. That unique, fun answer. No one has ever said that before. So that is awesome. We're going to have to look into that product as well. Okay. So as we conclude, Anthony, what is the best way for people to stay connected with you?
Yeah, I would say definitely on X. You can follow me, P Anthony LG. Should be on the screen as well.
Awesome. And then finally, as we close, just that one last, who are you? Who do you help serve? And what are you hoping to accomplish this year?
Yeah, definitely. Run Innovating Capital, technology fund based out of New York. Help to serve obviously the next wave of founders building what future of the world looks like in the next 10, 15, 20 years. And yeah, excited to keep doing what we're doing.
Wonderful. All right, Anthony, it was a pleasure having you on the show today. I'm so grateful for everyone watching today. We had dozens and dozens of viewers across all major platforms on our special segment, Funding, Faith, and Future Tech. We're going to look back on all these bold claims made by Anthony and myself here in New York City. We're excited for this, and we're going to go ahead and close on this. Please tune in to the David Daily Show on all major platforms, starting with LinkedIn live stream, my favorites. By the way, if you're wanting to go LinkedIn live or live on any platform like YouTube, Facebook, Instagram, Twitch, and others, please reach out to our team. We'd be happy to support you and bring you onto a show. And of course, you can repurpose the live content for podcasting, short form video, and all sorts of content. I will see you next week on Future, Faith, and Funding.